added some layers. As I described on what's going to be on the exam, you can see what some of those layers are going to be. Before we jump into bonds specifically, we're going to talk more generally about long-term debt, and then we'll spend the majority of our time, at least the rest of the time today, talking about bonds. One other thing I need to point out is that only the material we covered tonight from this chapter will be on the exam. Everything after, whatever we don't cover today, will be on the next exam. So the final exam, which is not cumulative, will be the second half of chapter 14 and chapter 15. So a chapter and a half, but that's plenty, I promise you. So chapter 14, bonds and long-term notes. So long-term debt in general, obligations that extend beyond 1 year or the operating cycle, whichever one is longer, signifies creditors' interest in a company's assets. It also kind of signifies how the firm has financed themselves. How did they get their money? Did they get it from investors? Did they earn the money and they're just keeping it internally? Or did they go out and borrow it? So how leveraged is this company is also some information that we get from this long-term debt. Requires the future payment of cash in specified or sometimes estimated amounts at a specified date. They are the mirror image of an asset. So I described this previously when we were doing investments, that in that chapter they go through a bunch of stuff about notes receivables and bond receivables. Well, we skipped that, so it's all coming back here. We're going to see it from both sides, both the investor side and from the person that's borrowing the money side. And we're going to do all the journal entries from both, and you're going to see that they really are a mirror image of each other. That being true, if you don't practice these enough, you will get them confused and you'll get them backwards. Don't do that. So you'll need at least enough practice to be able to differentiate between the two sides. All right, so for long-term debt, as time passes, interest accrues on debt. Periodic interest is the effective interest rate times the amount of debt outstanding during the interest period. This is what we call the effective interest method. So the effective interest method says, and I think I said this a couple times last time, and I'll say it one more time right now. The effective interest method says, if we have a long-term liability, or I guess we could expand that to, if we have a debt that accrues interest and time passes, we are going to record interest expense equal to the carrying value of the debt times the market rate of interest times the time period. And there's no avoiding that. That's what's going to happen every single time. Debt is reported at the present value of its related cash flows, discounted at the effective rate of interest at issuance. So the number that we see on our balance sheet for bonds payable or notes payable is the present value of future cash flows, discounted at the market rate of interest at issuance. So it doesn't matter if the market rate of interest changes over time, which it does. We ignore that. We only care about the issuance market rate of interest. Okay, so this is a key idea, that we only care about the issuance market rate of interest. After that time, it doesn't matter what happens to the market rate of interest, obviously, unless we pay it off early or something. And then many of these long-term debts have loan agreement restrictions, which we won't really talk about in here. All right, now we're going to specifically talk about bonds. And we're pretty much going to talk about bonds for the rest of our class period today. Bonds, the accounting for bonds is very similar to the accounting for any other long-term debt. So if you're talking about a note or a mortgage, the accounting is essentially the same thing. And so we just choose one long-term debt to be our example. And we're going to choose bonds for a number of reasons, one of which being it is by far the most common type of debt. So the amount of debt that is financed through bonds dwarfs any other kind of debt. And there's a number of reasons why bonds are used so much. Let's see, do we have any of those right here? This is probably the biggest reason. A bond issue divides a large liability into many smaller liabilities. So for example, let's say we're a firm, we want to go and raise $1 billion. Well, there's not a lot of financial institutions that are going to lend one firm $1 billion for some obvious reasons. They don't want to be so tied to you that if something happens to you, they're going to lose all of that money. They want to be able to diversify and lend lots of different people money, so if one fails, they're still okay. And so, for many firms, the amount of money they need to raise, it would be really hard to go to one financial institution and get all the money that they need to finance themselves. And you can think in tens of billions if you want to. It would be really hard to raise that from one particular institution. So instead of borrowing, we'll say $1 billion from one company, they're going to go and borrow $1,000 from 10,000 different people. And it could be that, some financial institutions buy hundreds or thousands of those, but you could also have an individual go and buy one of these bonds and essentially loan $1,000 to this company, along with, tens of or hundreds of thousands of other people lending the company money. So there's a liquidity associated with bonds that allows the firm to raise a lot more money by using bonds than they would be able to if they just borrowed it from one financial institution. Bonds are the most common type of corporate debt by far. Bonds require the payment of the stated amount at maturity and interest at a stated rate most of the time. There are exceptions to that. Maturity of bonds range from 10 to 40 years. So corporate bonds really are a long-term debt. 10 to 40 years is a long time. And so this really is a long-term debt that firms are using. Some bond vocabulary, and you're going to find that depending on who you talk to, they're going to use some of these different words. So I'm just giving you a variety of words that different people mean to mean the same thing. So the stated amount is also known as the principal, the par value, the face amount, and maturity value. These are all the same thing. Okay? So the textbook is going to use one. You go to your finance class, they're going to use a different one. You go to another class, you're going to use a different one. It's all the same thing. I tend to going to call this either the stated amount, the maturity value, or the principal. Those are my most common things that I call it. But any of these mean all the same thing. This is the amount printed on the bond, and that's going to be paid back usually at the end. That's the stated amount, or the principal, or the maturity value. The stated rate of interest, also known as the coupon rate or the nominal rate, is the interest rate printed on the bond. This is the amount that is used to calculate the cash payments that happen periodically. Okay, this stated rate, or this stated rate of interest, where do we get that number from? Obviously we get it printed on the bond. How does the firm decide what that number is going to be? They could try to get it close to the market if they want to. What were you saying?
I was saying that they multiply by the face value.
Nope. They get to pick any number they want. I can pick 0 or 50,000, right? I can pick any number and say, we're going to make interest payments of this amount. They can pick any number that they want. 0%, 5%, 10%, 250%. It's just a number that they pick, okay? Many firms pick something close to the market rate, or they just pick a nice round number. 0 is a nice round number. 8% is a nice round number. So this is just a choice by the firm. They pick a number, and they print it on the bond, and they say, this is what we're going to pay you. The next one, the market rate of interest, is the going interest rate of similarly risky debt. This, or another way of saying this is the amount that the investors are willing to accept because of the riskiness associated with this particular debt, which is obviously related to the riskiness of your firm. Where does this number come from? Can a manager pick this number? No. They're definitely not picking this number. This is associated with who the firm is. How risky is the firm? How risky is this debt? How much other debt does the firm already have? How profitable is the firm? How liquid is the firm? What are the prospects in the future? All of these things are associated with this number right here. So, can a firm change this number? No. Okay, so I heard yes and no, and the answer is yes and no. In the short term, can they change this number? No. There really isn't anything you can do in the short term. Long term, can you change this number? Okay, what are some of the things that you have to do to change this number long term? None of these are easy things.
Change your bond rating
So, okay, and how do you do that?
by being more credible, I guess.
Become less risky.
Yeah.
And how do you become less risky? Become more profitable. Become more liquid. Get rid of other debt. Right? But that kind of defeats the purpose if we're trying to borrow money. Getting rid of other debt. So these are long-term hard things. I mean, the biggest one is become more profitable. Not an easy thing for anybody to do. So you can influence this number. You can influence the wrong way as well by becoming less profitable. But in general, long-term you can move this somewhat, but short-term there's nothing to do. Yep.
So is, going back to the effective rate, would that be the same as the stated rate?
Where did you see
In your
effective rate?
Effective rate
Oh.
is the last, yeah.
Yes, that we use the market rate for the effective. Where do you see the effective rate? I don't see
In
it.
the long-term debt and in the general, I have no last bullet point.
Yes, that is the market rate. of
That is
interest.
the market
Yep.
rate. So at issuance.
At issuance. So it only matters for the accounting at the issuance date.
Okay,
Now, as time passes, you can obviously refinance this. If your riskiness goes down, you can pay it off and get a new loan for, issue new bonds at a lower interest rate, potentially. And we'll talk a little bit about that, not today, but after the exam. And we'll deal with some of those issues after the exam. But yes, the market rate is the same thing as the effective rate.
thank you.
Bond indenture, the document that describes the promises made to bondholders. Every bond issuance has one of these because it has to be really clear and it's going to be written in legal terms, so it has to go and be go through the courts that it can, and people get what they are promised. So these three we're going to use a lot: stated amount, stated rate, and market rate, because these are going to change how we account for things depending on what these numbers are. All right, types of bonds. We are not going to go through all these in class. These are your responsibility to read through these and understand the differences between these different types of bonds. Debenture, subordinated, mortgage bonds, registered bonds, coupon bonds, callable, sinking funds, serial bonds, convertible bonds, zero coupon bonds, and a private placement. All of these things, your responsibility to learn on your own. It's just, I could talk about all of them individually, but you can learn them just as easily by reading the textbook and learning what they all mean. So we're going to skip that part here in class. All right, so where we're going to go next is determining the selling price. So this material you've already talked about in your previous class. You know when a bond is issued at the stated amount, at a premium, at a discount. It's all about where the market rate versus the stated rate of interest is. If the market rate equals the stated rate, market rate are equal, then the bonds are going to sell at the face amount and the stated interest is going to be equal to the market rate. Does everyone remember this, at least sort of? Okay, we're going to do examples of this in just a second, so it'll cement this in your mind as we go through those. If, for example, the market rate is above the stated rate, as we have here, then they're going to be issued at a discount. The reasoning behind this, and at least the intuition where my brain takes me, and it will probably help you as well. Think about this. I'm paying 8%. Everyone else is paying 10%. If you're an investor, are you going to want to invest in this company that's only paying 8%? No. So you're going to pay less than what the face amount is. And that's exactly what happens. It gets issued at a discount, something less than what that stated amount is. Similarly, if they're paying 12% and everyone else is paying 10%, then as an investor, you're going to be willing to pay more for that, and so it's going to be issued at a premium. It's something above the face amount, and so it's going to be issued at a premium, and so that's pretty straightforward. Any questions about that idea? Those are the only options. Stated is bigger than market, market is bigger than stated, they're equal, there are no other options. That's all of the options. How do we determine the market rate? So we talked about some of the things that can influence, but as an accountant, we actually, when we issue a bond, we have to say, all right, this is the stated rate we chose, we picked this number, we picked 10% as our stated rate. Well, how do we get the market rate that we're going to use? Because we need to know the market rate as of the issuance date. Where do we get that from?
Just compare it to other debt that's the same risk. Must be.
That's exactly what we do. So there's a variety of tools we can use. There's debt rating agencies. And basically what that does is that compares you to other debt of similar riskiness. And then you can then determine, well, what is the market rate of those? And then you can make adjustments to figure out what yours would be compared to those other ones. That's exactly right. If you're in a finance class, that's not the answer. You use some asset valuation tool to do that. There are some finance tools you can use to try to come up with a similar kind of thing, but that's in practice not usually what happens. Usually we're just going to compare ourselves to something similar and use that information. All right, example number 1. Bonds issued at face value. And you're going to see, we're going to do a number of examples today. The first one's at face value. The second one is going to be, I think, at a premium or discount, I can't remember, discount. And then we'll do a premium, and you're going to see that the format of these are all very similar. And in fact, the problems are all very similar. We're just basically going to be changing one thing each time and see what that affects as we do this. So this basic format is we're going to be using a bunch of times. Example 1, bonds sold at face value. On January 1st, 2009, Lauren Industries issued $1 million of 10% bonds. So what is the $1 million? What is that called?
Face amount.
Face amount, or stated amount, or maturity value, principal, all those things. What is the 10%?
Just stated.
Stated.
So far we know this is just a stated rate. Interest is payable semi-annually, so most bonds are paid semi-annually, so we're going to follow that example, and all of our examples are going to be paid semi-annually. All right, in this case, since it issued on January 1st, it's going to be paid out June 30th and December 31st. The bonds mature in 3 years, an unrealistically short maturity to shorten the illustration, and you're going to see that we're going to use 3 years for all of these because we don't want to figure it out for 40 years, that would take forever. So we're going to do these with 3 years. The entire bond issue was sold in a private placement to Abigail Corporation at face amount. So what does at face amount tell us?
So it was equal, the market rate was equal,
Market rate is
the market rate and the stated rate was equal.
The market rate and the stated rate are equal. So this stated rate is also the market rate of interest. And the amount of cash that's going to change hands is going to be this face amount, this principal amount, the $1 million. That's how much the investor is going to pay. The investor whose name is Abigail, that's how much Abigail is going to pay to Lauren at the issuance of this bond. So here we have Lauren, the issuer, which incidentally is my 8-year-old, and Abigail, which is my 6-year-old, is our investor. I don't know where they got all this money from. And so we're going to do the journal entries first for the issuer at issuance is going to receive cash of $1 million, and then is going to record a bond payable for the same amount. And similarly, Abigail, the investor, you could either call this a bond receivable or an investment. I'm going to go ahead and call this an investment, just to connect this to what we talked about earlier with the investment. What kind of investment is this?
held to maturity.
This is a held-to-maturity investment. Very good. That is the accounting that Abigail is going to use for this. They're going to account for this as a held-to-maturity investment. All right, the journal entries from here on out, we would have interest payments, and then we're going to pay back at the end. They're not interesting for when they're being issued at face amount, so we're not going to do them. But they're going to be really obvious. You're going to figure out the amount of the cash payments. It's going to be $1 million times 10% times 1/2. You're going to credit cash and debit interest expense. And then the opposite side, you're going to debit cash and credit interest revenue. And that would be it. So we're not going to even bother to do it because it's so straightforward. Instead, we're going to go to our next example, which which is bonds issued at a discount. So, very similar question. Still January 1st, 2009, still Lauren, still Abigail. $1 million is still our stated amount. 10% is still our stated rate. Interest is paid semi-annually on the same days. The bonds mature in 3 years. The bond yield for bonds of similar risk and maturity is 12%. What is the 12%?
Market rate.
This is the market rate of interest. The entire bond was purchased by Abigail Corporation. All right, so this time, we already know it's going to be issued at a discount. Why? Because we're paying 10%, or specifically Lauren is paying 10%, and Abigail is demanding 12%. Essentially what's going to happen is that the investor always gets the percentage that they demand. Otherwise they won't buy it. Okay? So they're going to demand the market rate of 12%, and essentially what's going to happen is the initial cash flow is going to make it so that they always get that return. So Abigail is going to get her 12% return. And that's what the discount is doing, is to make it so she gets that return. So the first thing we need to do is we need to pull out some of our present value with future cash flows skills, and we need to figure out what is the amount that this particular investment is going to be issued at, or this bond is going to be issued at. So we'll draw a picture for this one of what the cash flows look like. This is a total of 3 years, and it's semi-annual. And so here's January 1st, 2009. Here's the end of 2009, into 2010, into 2011. And so, first of all, we know that at the very end, the $1 million is going to get paid back. So our issuer is going to pay back to the investor $1 million at the end. There's also going to be interest payments that happen at the end of each of these 6-month intervals. To determine the interest rate, we always take the stated amount and multiply it by the stated rate, and then by the time period. So in this case, it's going to be $1 million times the stated rate, which is 10%. And in this case, it's going to be 6 out of 12 months for a 6-month period. And that's going to give us $50,000 per every 6 months. So 50,000, 50,000, 50,000, 50,000, and 50,000 at the end.
How do you get it 6 over 12?
6 over 12, because it's a semi-annual bond, so it gets paid every 6 months. These interest rates are all annual interest rates, but we're only dealing with 6-month periods, so we gotta adjust it to get to the 6 months. So these are the cash flows that are coming from the issuer to the investor. At the very beginning, the investor is going to pay some money to the issuer. And that is the number we need to figure out, is this number that goes right here. It goes the opposite direction of all